when we're talking about options, I want to start off with just your general thesis. You say investors, if they want to hedge some potential volatility, they should look at out-of-the-money options. Just explain that strategy.
Yeah, right now, the markets are quite complacent. The VIX is around 17%. You look at the VIX futures curve, it's quite steep, which really means that the front month futures, meaning the 30-day VIX expectation of volatility over the next 30 days, is quite low relative to what we expect going out about 90 days. So that gives an opportunity for options buyers to basically buy protection to the downside for relatively inexpensive. So you can go out to August and buy, let's say, a 610 put on SPY or 6100 on SPX for roughly 1% of the stock or ETF's value. And that's a pretty cheap way to hedge some downside risk if you're concerned about the fact that we won't reach a deal by August 1st and we see, major countries like the EU and India potentially retaliate with some tariffs. That's kind of our worst case scenario at the moment. The market is not pricing in that. But if that were to happen, an out-of-the-money hedge would be a very cheap and effective way to protect your downside portfolio.
All right, let's go through a few scenarios here, Tony. So let's say two big trading partners, the EU and India, they say, we don't want to make a deal, and that becomes a bit contentious. How would you play that in the options market?
So in that particular case, I think that the easiest way to do that is the straight, simple, out-of-the-money put option. Like I said, going out to August, if you buy a 610 put on SPY, 6100 on SPX, that's going to cost you 1% of that of your portfolio's value to buy that hedge. And that gives you a significant downside protection for relatively inexpensive. And I think one way that you can also offset the cost of that protection is to also consider selling some upside calls right now. So if you own stocks or ETFs in your portfolio, you can sell some cover calls. You could probably collect close to 0.5% of the stocks of your portfolio's value in the next 30 days and use that to buy that downside put. And that's probably the simplest way, in my opinion, to hedge that kind of worst case scenario that you're laying out.
All right, let's go to the other side of the coin here. Potential, quote unquote, taco trade that the president just extends the deadline. It kind of just keeps going on. If you're an investor, how do you play that?
So you would take the exact same trade that I'm doing right now. And what's great about this particular trade is that, let's say by August 1st, we find that, that's not the true deadline. We're going to kick it out another 30 days or longer. Then what you simply do is you just roll out your options. So instead of buying the August options, you go out to September. And what that allows you to do is probably the cost of those September puts will probably be a little bit higher, but not meaningfully higher. And by that time, you've collected maybe 0.5%, 0.75% of your portfolio's value selling those cover calls, and you can do that again. So you're just going to continuously try to harvest some premium by selling upside calls against your portfolio and use the proceeds to buy some downside put protection in this particular case if we simply have to buy more time or buy more protection going out further beyond that August 1st expiration.
All right, one more scenario. I think this is what a lot of investors I talk to see as the most likely scenario, that countries and nation blocs like the EU, they capitulate. They decide to make a deal with the president. What do you expect to happen in the market, and then how do you play that in options?
Yeah, that's exactly what the market seems to be pricing in right now as the most likely outcome. So if that is the case, I think for most investors, what you can do actually to start off with is to not do anything at the moment if that is your base case as well. And if that becomes reality, I think one of the things that you can do is that markets will likely react relatively positively to that news, even though it's relatively priced in my opinion. But that's really where I would look at maybe selling some downside puts and even using those proceeds to fund buying some upside calls. This way you can basically get upside participation without necessarily paying for it so much by selling those downside puts. So at the moment, that is the market's base case. And I think that's the best way to play that, is to actually, for now, not do anything unless you're concerned that there's the risk that those major countries like EU and India are not going to play ball. If that's the case, then I would definitely be buying puts at the moment.